Let go of what you can't control. A trader cannot control the market news or price movements, but they can control their reactions, risk management, and decision-making process. Instead of worrying about external factors, focus on executing your strategy with discipline. Develop emotional control. Markets will test a trader's patience. There will be days of frustration, fear, and doubt. Instead of reacting impulsively, mentally strong traders take a step back. Techniques like deep breathing, mindfulness, and stepping away from the screen help in regaining emotional balance. The power of routine and discipline. A mentally strong trader follows a disciplined approach no matter how the market behaves. Some key habits include having a pre-market routine, reviewing the market, planning trades, and mentally preparing. Following a trading plan, entering and exiting trades based on strategy, not emotions. Tracking performance, keeping a journal of trades, mistakes, and lessons learned. Taking breaks, avoiding burnout by stepping away when needed. Discipline is the foundation of mental strength in trading. Without it, emotions take over, leading to inconsistent results. By developing mental strength, traders gain the confidence to make rational decisions, manage risk effectively, and navigate the market with a clear, focused mind. Developing your personal trading system. Every successful trader follows a system, a structured approach that guides their decisions. Sharp execution maximizes profits, turning potential gains into substantial financial rewards. Maximized profits provide the funds necessary for further learning and skill development. Further learning allows a trader to refine their strategies, making them more effective over time. Refined strategies enable a trader to adapt seamlessly to unexpected market shifts and changes. Market shifts demand a high level of flexibility from a trader to stay competitive and relevant. Flexibility effectively prevents rigid losses that can derail a trader's progress and morale. Prevented losses significantly strengthen a trader's resilience, building a foundation for recovery. Resilience equips a trader to navigate downturns with confidence and strategic foresight. Downturns put a trader's discipline to the ultimate test, challenging their commitment to the plan. Discipline ensures a trader's survival during crises, providing a lifeline in turbulent times. Survival during crises helps build a trader's character, shaping their approach to future challenges. Character profoundly shapes a trader's reputation, earning respect within the trading community. Reputation naturally attracts valuable connections, opening doors to collaborative opportunities. Valuable connections provide insightful advice and perspectives that enhance trading knowledge. Insights greatly improve a trader's ability to make accurate market predictions with confidence. Improved predictions enhance a trader's timing, allowing for perfectly synchronized trade entries. Enhanced timing boosts a trader's trade efficiency, streamlining their operational workflow. Trade efficiency effectively saves valuable resources, preserving them for future use. Saved resources can be reinvested wisely to maximize long-term trading potential. Wise reinvestment compounds gains, creating a snowball effect of financial growth. Compounded gains accelerate wealth accumulation, transforming modest profits into fortunes. Wealth accumulation requires unwavering patience to weather the ups and downs of the market. Patience effectively prevents impulsive actions that could jeopardize a trader's strategy. Impulsive actions often lead to deep regret, haunting a trader's future decisions. Regret teaches critical lessons that shape a trader's growth and understanding of the market. Lessons improve a trader's future performance, turning past mistakes into valuable assets. Improved performance attracts new opportunities, drawing attention from the trading community. Opportunities expand a trader's horizons, encouraging exploration of new market territories. Expanded horizons require adaptability to thrive in diverse and changing conditions. Adaptability ensures a trader's survival amidst the unpredictable nature of market shifts. Changing markets test a trader's resilience, pushing their limits to adapt and persevere. Resilience helps a trader overcome setbacks, turning obstacles into stepping stones for growth. Setbacks are an integral part of the learning curve, offering rich experiences for development. The learning curve shapes a trader's growth, molding their skills through persistent effort. Growth leads to mastery over time, establishing a trader as an expert in their field. A tight SL gets you sacked by a quick dip. A sloppy TP? You missed the end zone. This 15-play playbook coaches you from rookie to MVP, turning losses into championships with SL and TP mastery. Your entry's just 10%. Exits are 90% of the game. Over the next hour, we'll run 15 plays, from crafting your playbook to dodging mental blitzes, outsmarting market sharks, and scoring max profits. These aren't tips, they're battle-tested moves to dominate. Ready to play? Let's roll. Picture a locker room, Super Bowl Sunday, sketching plays on a whiteboard. That's your risk-reward ratio, RRR, your guide through market chaos. No playbook, you're blind. With it, every snap's calculated. It's your map to the end zone. Many traders stick to a rigid 1:2 RRR like it's the only play. Markets shift like a playoff defense. Take a 1 minute and 1.5 seconds field goal in volatile earnings season or a 1:3 Hail Mary in a roaring bull run. Flexibility is your edge. A trader ran a fixed 1:2 RRR on every trade. In a choppy index breakout, the distant TP was like a 50-yard pass in a blitz, price teased, then reversed, leaving no score. Rigid plays lose when markets pivot. A sharp coach adjusts, bagging points before the turnover. Your RRR's alive, redrawn with market shifts. Forcing a fixed ratio is like running the same play every down, predictable and costly. Adapt to win. In a tight market, like post-news consolidation, a 1:1 RRR keeps you safe like a short pass. In a trending market, a 1:4 RRR could be your long bomb. Example, a 1:3 RRR on a stock rally caught 3 are where 1:2 missed. Check your last 10 trades. How often did you force a preset RRR when the market signaled otherwise? Over 3, you're leaving points on the field. Markets reward coaches who adapt. Redraw your playbook now. Exercise. Test 2 RRRs, 1:2, 1:3, on your next trade in a demo account. Note which fits the market's flow. Did 1:3 catch a bigger move, or 1:2 save you in chop? Data shows your edge. Example, a trader used 1:2 on a Forex pair, missed a 4 trend. Checking chart patterns, 1:3 align better. Markets aren't static. Your RRR shouldn't be. Pivot to match the game's flow. The fiercest fights in your head. Fear and greed hit like linebackers, shredding plans. Fear yanks your SL tight, screaming sack coming. Losing on small dips. Greed stretches TP, risking a fumble. A trader had a gold setup, TP at $2,090, ATR-based to sell. At $2,085, greed pushed for more. A dip wiped the gains. Fear's brutal, tightening SLs to choke profits before they grow. Loss aversion stings twice as hard as wins feel good. Anchoring bias locks you to first numbers. Up 2R, plan says 3R, but panic makes you punt early? Price hits your target? That's the mental fumble. SL/TP reflect your mindset. Perfect playbook? Useless if emotions call the shots. Write your last emotional misstep. What sparked it? What did it cost? Awareness blocks the mental blitz. A trader moved SL tighter on a winning trade, fearing a reversal. Price wobbled, stopped out, then hit the original TP. Journaling showed fear drove 60% of exits. Logic, not emotion, is your coach. Exercise. For 3 trades, note the emotion before closing. Fear, greed, doubt. Compare to your plan. Did emotion cost or multiples? A trader found greed cut 2 are gains. Awareness builds discipline. Example, a trader stuck to a 2 are TP, banked gains before a reversal. Another chased 5 are lost it all. Pause before trades. Deep breath. Check your plan. Emotions fade. Discipline scores. Science says losses feel twice as painful as wins. A trader journaled emotions, cut fear-driven exits by 50%. Try it. Log emotions for 5 trades. Spot patterns, break the cycle. Every team's got a salary cap. Overpay, one bad play tanks you. Underpay, you miss talent. Risk per trade is your cap. Capital bet per snap. A trader with a $50,000 account risked 10% per trade. Early wins stacked up, but 3 losses cut 30% in a week. Morale tanked, playbook gone. Another trader risked 2%. Bad plays lost little, squad stayed in the game, strategy intact. Risk your cap. Too heavy, you collapse. Too light, no firepower. Position sizing matches risk to SL width. Tight, SL. Stack the roster. Wide, keep it lean. Fixed bets ignore market flow. Formula. Account size x risk percent / SL distance equals position size. For $10,000, 2% risk, $200. 50 pip SL equals 0.4 lots on Forex. Math, not gut. Write it. Your roster blueprint. A trader risked 5% per trade, ignoring SL width. A volatile week wiped half the account. Switching to 1% risk, size to ATR, weather losses. Blow-ups come from overspending. Exercise. Calculate position size for your next trade using the formula. Compare to your usual size. Did it reduce losses or boost confidence? Balanced rosters keep you playing. Example. A trader with $20,000 risked 3%, lost $3,000 in a week. At 1% risk, losses were $1,000, then a 5 or win recovered all. Small risks let you stay in for big plays. A trader used fixed lots, ignored volatility. Losses piled up in wild markets. Sizing to 1% and ATR cut losses by 40%. Try it. Size 3 trades to 1% risk. Did it stabilize your account? Bad defense, you're toast. Too tight, a short pass picks you off. Too loose, out of position. SL's your defensive line. On a crypto trade, price surged past $27,500. A tight SL below $27,300 got blitzed. A dip stopped the tight SL, then price hit $30,000. Another trader used an ATR-based SL, deeper, rode the hit for 3x points. Avoid obvious zones. Swing lows are blitz magnets. Volatility SLs, ATR, give room. Match to the game. Tight in steady markets, loose in choppy ones. Ask. 1. Where's the crowd defending? 2. What's ATR saying? 3. Where would a market shark attack? These dodge sacks. Markets hunt clusters. Swing lows are crowded sidelines. Set SL 20 pips below key levels, not on them. Example. A stock SL at $99, not $100, survived a hunt. A trader set SLs at round numbers, got stopped repeatedly. Adding a 25% ATR buffer dodge hunts, save 2R. Exercise. Set SL 1.5x ATR from support on your next trade. Did survive? Example. A Forex trade used a 4-hour ATR SL, dodged a hunt, rode to 3R. Tight SLs lost out. Try multi-time frame SLs, daily support, adjusted on 1 hour. Test for better survival. A trader used daily support for SLs, got hit by intraday noise. Adding a 1-hour buffer saved 2R. Exercise. Check 2 time frames for your next SL. Did it avoid early stops? Example. A crypto trade set SL at $25,000 support, got hunted at $24,950. A 1.5x ATR SL at $24,900 rode to $26,000. Buffers beat obvious levels. Test it. Did it save your trade? No coach hopes for luck. They target the end zone. TP too close? Just a field goal. Too far? Fumble. Round numbers or fixed ratios. Amateur. Read the field. Fibonacci, supply zones, liquidity pools. Short plays in shaky markets. Deep shots in trends like post-news rallies. Power move. Scaling TP. Score partials to cover costs. Bank more. Chase big. A Forex breakout. Scaled out at 3 resistances. Exercise. Set 3 TPs on your next trade. Use Fibonacci levels or resistance zones. A trader scaled at $210, $220, $230 on a stock. Lock 2R, chase 4R. Did scaling save you from a dip or boost profits? Test it to find your edge. Your stop loss, SL, is your defense. Shift it to win. Move to break even at 1 or to lock 0 loss. Trail SL to ride trends. A Forex trade trailed by 1x ATR. Caught plus 150 pips versus plus 80 for fixed SLs. Dynamic defense keeps you in the game. Exercise. On your next winning trade, move to break even at 1R. Trail SL by 1x ATR or swing lows. A trader trailed behind swing highs on a stock. NAB 4R. Did trailing lock more gains or cut you short? Data builds your playbook. Your SL/TP playbook is your Super Bowl strategy. Key plays. Risk 1 to 2% per trade. Use ATR-based SLs. Scale TPs at logical levels. Adjust for market regimes. Dodge stop hunts. Measure inner multiples. Automate for discipline. A trader used 1% risk. ATR SL. 3 TPs on a crypto trade. Turned $5,000 into $7,000 in months. Manual traders lost to emotion. Exercise. Write 5 questions before your next trade. 1. Risk in R. 2. SL placement. 3. TP levels. Trend or range. 5. Profit protection. A trader answered these, boosted our multiples by 30%. Test it. Plan 1 trade with all 5 answers. Execute. Review. Did sharpen your game? A playbook wins championships. Entries are the snap. Exits are the score. A trader nailed a $25,000 crypto entry, but fumbled with a tight SL. Price hit $30,000 after stopping out. Smart SL/TP would have scored 5R. Exits turn good calls into game winners. You got the playbook. 15 plays to dominate markets. Log your next trade differently. Note why you set that SL. Calculate our multiples. Plan 3 TPs. Markets are a brutal field, but you're no rookie. Ready to play smarter? Share your next trade in the comments. Type Playmaker if you're applying one lesson from this video. Which play hit home? Scaling TPs? Automating SLs? Your story could spark another trader's win. Subscribe to Trader Tales for more. Next day, we tackle bouncing back from losses like a championship team. Then, sizing bets to match your mindset, not just your account. Comment Playmaker, share your trade plan, and play different now. The market's waiting. Make your move.